ago, we did couple of sessions on agents financials, and we have been scheduled to come and talk, share with us business entities and taxes. It couldn't happen at that time. Thank God we have him here today. So here is the Symeonides. His information is on the chat for you guys, to have it for the future. We are covering two things today: the business entities in relation to real estate businesses, you as owners of your real estate business, and then taxes. The way I thought about this, this is basically, it's not really a class. It is us having the privilege of having Dean here for any questions that we may have. But I would like to start with the business entities. And maybe after that, you guys ask your questions, and then we move to the taxes, if that is okay. Is that okay? So Dean, I'm gonna start with my question. One of the questions that I get from the agents is, I just created an LLC, and I would like you to write my commission checks to my LLC.
Okay, so that cannot happen. We people in the state of New Jersey that are licensed through the state of New Jersey are licensed by our own names. They will not issue a license to an entity that we create, okay? So as real estate agents, when you are paid, you are required to be paid in the name of your license. Presumably that's your full name. You then take that commission check, you deposit it into your personal checking account, and then you write another check or transfer through your bank, whatever way you do things, to your LLC checking account that you've established for the new entity that you created. When you create an entity, it could be your name with LLC at the end. It could be a generic name like the Best Real Estate Office, LLC, whatever you call yourself. You should have that entity and probably a tax identification number that you got from the federal government when you formed the entity. You simply transfer the money that was deposited from Keller Williams to your personal account. You then move it to your LLC. That's the way the movement of the money should go. Once it's in the LLC, that LLC checking account should be used only for business activity. So only deposits that go into that LLC checking account are from the commissions that you earn as real estate agents. The expenses that you pay out of that account are strictly business expenses. Telephone, dues, travel, computer supplies, anything you have to pay for to earn your money, car payments that goes through that account is considered a potential tax deduction, okay? You do not pay out of that business account any blatantly personal expenses. Your trip to Hawaii for a vacation, for example, is blatantly personal. So things of that nature. I'll leave everybody to understand their own personal expenses. You use them, you pay them out of your personal account. From your LLC checking account that you've established, you're going to create profit for yourself. The money that came in is your revenue. You have these deductions, and you want that profit. At that time, you can move that money any place you want, whatever you want. Anytime you want to move profit from your LLC checking account to either the original account that it came from, some investment account, a savings account. You want to cash a check to your name and put the cash in your pocket. Those are all options that you have. But this is generally the flow of the money when you have an entity. And Patricia used LLC as an example.
Dean, there are other business entities types. There are corporations, there are partnerships. What is your recommendation, or what are the advantages or disadvantages of creating it one way or the other? And what is the risk assumed by the agent when they do that?
Okay, good question. The answer to the question is that an entity that is formed, whether it's an LLC, which is for limited liability company, or if it's a corporation that you form, The first reason that that entity is formed is not for accounting or taxes. It's for legal reasons. Those are legal entities. You're getting a legal protection that puts a wall between your business activity and your personal activity. And if you don't create an entity and you operate as a sole proprietor, which many realtors do, sole proprietor just means that you're operating under your own name with no other entity formed. If that's what you do and you are sued and there's some major lawsuit against you, your personal assets as well as your business assets are exposed to that lawsuit. By forming an entity like an LLC or a corporation, there's a wall that goes up between your business and your personal life. So even though you may get sued, your attorney should be able to successfully defend your personal assets as not being involved because you have this entity, which is where you transpire all your business. Okay. So that's the first reason why you're an entity. The second question is, okay, I'm going to form an entity for legal reasons. What are the tax implications of this? Which is best for me tax-wise? An LLC, limited liability company, and I'll just say this flat out, gives you zero tax benefits. Absolutely zero, which may surprise many of you on this call. An LLC is a flow-through entity, just like an S corporation is, but it does not provide any type of a shelter of taxes. It's just a vehicle to have your legal protections and also to consolidate your business activity. You can consolidate your activity in one checking account under your own name as well, but the LLC is used and the corporation is used in conjunction with legal reasons. So once again, LLC does not give you $1 of tax benefit. Now, if you're a single owner or you're working independently, then you are a single member LLC. That's what you ended up forming. That's called a disregarded entity for tax purposes. That basically means the IRS does not even recognize a separate entity as an LLC as a tax vehicle. You would file the same tax form that you always have, a Schedule C within your personal return. A Schedule C is a separate form that accounts for your business income and your business expenses. However, if you are in a team, you have one or more members and you form a team. That team can have an LLC of its own, and that team would have a separate tax ID number. Now, that's a partnership. When you have two or more people in an LLC, that is by law a partnership. You would file a separate tax return for that partnership for your team, whether it's two or more people. You account for all the commissions from everybody that are partners in that partnership in one checking account. You pay all the business expenses out of that one checking account, and you distribute profits to the individual owners from that one checking account. Everybody at the end of the year would get a K-1. A K-1 is a form within the partnership's tax return that has every partner's name and social security number on it and has your share of whatever the profit or loss is from that business for that year. And that's how you pay your taxes. There's going to be two line items on it, minimum. Ordinary income or loss. So let's say you made money in your partnership. Ordinary income means that you made money. And then there's self-employment earnings toward the bottom of the K-1, which means that these earnings that you earned were self-employed earnings. You were self-employed. Partnerships are self-employed entities, just like a sole proprietor is. So you're paying income taxes and social security taxes. Now, I do many tax returns for many real estate agents, many. There's some of them that I have structured as S corporations and others that are LLCs and others that don't want to do anything. They just want to be a sole proprietor. The reason why somebody would say I want to be taxed as an S corporation is if their profits are significantly high enough every year where the S corporation structure is going to save them money. Because the way S corporations are taxed, it's taxed differently than an LLC. The profits are not subject to employment taxes like an LLC is or a sole proprietor. S corporations can save you tax dollars if you're making over a certain amount of money. Now that is a kind of a moving target It all depends on your personal income status, whether you're married and file a joint return or not, what your other income might be. There's all kinds of reasons that go into that decision. But an S corporation can definitely save you money if you fall into that category. And I'm just going to use an example of about $100,000. If your profits from your business, not your commissions, your profits after deducting everything that we would normally deduct, is $100,000 or more, you could very well benefit from the S corp structure. And it would have to be a structure. You would have to pay salary to yourself, unlike LLCs and sole proprietors that don't allow you to pay a salary to yourself. You're not eligible to do that. With the S corporation, it's opposite. You must pay yourself a salary for at least part of your income. But the profits after deducting that salary are not subject to employment taxes. And this function can allow taxpayers who have these S corporations to save tax dollars every year. I have clients that are saving $5,000 to $12,000 every single year by just having an S corp as opposed to an LLC or a sole proprietorship. But it does depend on all these other factors that I mentioned. It's not just a slam dunk. And I'll just say one more thing, Patricia, before we move on to questions or whatever. The S corporation comes with certain inherent costs that the LLC and sole proprietorship do not have. The S corporation requires a separate return. So you have to hire a guy like me to file this corporate return. You have to pay yourself a payroll, which means you have to employ a payroll service. That could be as much as $1,000 a year. You have to then have workers' compensation insurance by law in the state of New Jersey for anybody that has payroll, including you as an owner. That's going to cost several $100s. And there are franchise taxes that a corporation has, even an S corp, that the LLC does not. That could be anywhere from $500 to $1,500, depending on your level of sales income. So let's just say that the S corporation structure, you have at least $3,000 of inherent costs that you don't have with the LLC. So you better be sure that this tax savings that you're going to get with this S corporation that I've been telling you about are going to exceed $3,000. Otherwise, it's not worth it. Now, the LLC is an entity, S corporation is an entity. Some people, what they do is they form an LLC and then they convert that LLC to S corporation taxation later. Let's say you're doing pretty good right now, but you're not making enough money to warrant enough tax savings to at least pay for the $3,000 of cost that I mentioned. But you think you're going to be getting there. You form an LLC now, and then when your income starts to rise and you're getting, more and more profitable, this S corporation may make more sense for you. And if it does, all we have to do is elect to be taxed as an S corporation. You don't have to form another entity. You don't have to get a new tax ID number. You don't have to change your business name. You simply elect with the government to say this LLC going forward will be taxed as an S corporation. It'll always be an LLC, just the taxation portion is corporate, S corporation. S corporation as well has a K1, just like the LLC does. The profits flow to your individual tax return, but the way it's taxed, as I said, is different than the LLC structure. So look, I know I just said a mouthful, a lot of information to take in, especially if you're hearing it for the first time. If you have questions, I would understand that. I can always repeat myself, but that's the beginning of the process.
So basically, there is not a right or wrong way to do this. It is actually based on each individual and their income and what are they trying to achieve with this, right?
That's correct.
Would you say that maybe the normal way or the logical way to start will be the LLC, and then if the income allows, goes to the SC corporation?
I think it depends on if a person listening to this is already at a high level of production, making reasonable amount of money, and that's reasonable is sort of whatever is reasonable to you. But in dollars and cents, if you're making over $100,000 of net profit, I think S corporation should be on the table. on the table to discuss. It might not be what we would decide to do, but it might very well be. So it all depends on the individual. Like I did one of these Zoom webinars yesterday, and I got called by an agent that said, I'm already making $300,000. Well, good for her, right? She's doing very well. She's a candidate right this second for an S corporation because at that level of income, it's a no-brainer.
I understand.
If you're making 80 or 70 or maybe even 100, it's not quite a no-brainer because as soon as you step into the arena of an S corporation taxation, you have $3,000 or so that you have to pay out of your pocket. We better make sure that you're going to gain a benefit higher than that. Otherwise, it's not worth it. Okay.
It makes sense. I'm gonna read one of the questions on the chat. Is Jennifer is asking, how best do you suggest we set the LLC? Attorney or with the CPA or online? And then the second question is, if you own multiple rental properties and you are a realtor, do you suggest an LLC for each property and separate for a realtor business?
Okay, two very good questions. Let me address the first one. How do you best suggest we set up an LLC, attorney, online, CPA? Any of those choices. If you're able to do it on your own, certainly you can do it on your own. The process is as follows. There's actually 3 steps. Okay. The first step is you go to the New Jersey website, the Division of Revenue website, and you file for a formation document. The name that you call yourself has to be available on the state records. Okay. Assuming it is, you form the entity at the state level, you get what's called a certificate of formation. That costs approximately $125. That's what the state charges you for this. When you get your certificate of formation, you then go to the Internal Revenue Service website and you apply for an EIN, Employer Identification Number. Now, you may not be an employer, but you have to get an EIN for this business. So you go through the question and answer process on the IRS website. At the end of that process, they give you a letter, which you print, and it shows you what your federal tax ID number is, and it tells you what kind of tax return you have to file for the application that you submitted, whether you're a sole proprietor, a partnership, or an S corp. And the third step is, after the first 2 are done, you go back to the New Jersey website and you register the business. You tell them what the federal tax ID number is that you just received from the IRS, what kind of business you're in, who the owners are going to be, where you're located, any other taxes that you might be subject to, like employment taxes if you have payroll. A registration is a completely different process than a formation in the state. The formation is just a couple questions and you're done. The registration is much more, but it's all done online. So anybody that's able to do this on their own, hey, go for it. You don't need an accountant like me. You don't need an attorney. You've done it all, and hopefully it's done right. But I'll tell you the truth. In my experience, 8 or 9 out of 10 that do this do something wrong. They do something wrong in these questions and answers, and it messes them up. And they need to fix it, and then they can't fix it, and they have to hire me. It ends up costing more to fix many times than it was if I just did it from the outset. Okay. So I form a lot of companies, so do attorneys. Yes, we charge for our services. I mean, for KW Family, which I'm part of here, I would do it at a fee that I think is reasonable. In my case, I charge $750 to form a company. That includes the $125 that the state is going to charge you anyway. And you get all 3 of those steps that I mentioned: the formation, the EIN from the feds, and then the registration. If you decide that you want to be an S corp from the outset, there's another set of steps you have to take. You have to, because when you form an entity, even an S corp, even a corporate entity, you have to elect to become an S corp. It's not just a choice from the outset that you can make. And that election is a manual filling out a form process that you have to send to the federal and state governments. And that's time consuming and a little more effort So when I do that, I charge a minimum of $1,000, all inclusive, including the S corporation elections. That's what I charge. But like I said, to answer your question in a roundabout way, you can do it all yourself if you want to, but just be wary of the pitfalls. Your second question is, if you own multiple rental properties and you're also a realtor, do you suggest an LLC for each property and separate for real estate? So real estate ownership is different than operating business, like a commission salesperson business. Rental real estate, LLCs are perfect for rental real estate ownership. You would not want to form a corporation for that. You don't need to do that and pay the franchise taxes for no reason. You form an LLC for that business. Hopefully you can close in the name of the LLC. That's the idea here. You want the deed to be in the name of the LLC. If you want to form an LLC after owning it in your personal name, you have to have the deed changed over to the LLC name because you would like the name of the LLC to own that property. From a tax perspective, you would like each and every property that you own to be in a separate LLC. You separate your legal liabilities from one property to another. And you also, there's also a tax reason for that. If you sell the property and it has losses that are built in, those losses are deductible to you when you sell the property. If you have multiple properties under one LLC and you have one that you sell and it has a loss, you can't deduct those losses because the entity is still open. So separate LLC for each real estate property is what I would recommend.
Thank you, Dean. Not because Dean is here in front of us, but Dean has been part of the Keller Williams family, at least that I know, for 10 years. He not only helps us as a company here in Jersey City, but he's the personal CPA for many of us. And, he knows what he's doing. So this is my suggestion, not again, because of Dean, hire a professional because we are not professionals. And at the end, this can, save you money. There is a question from Karen. If you just need to, the S corporation, how much? If you just need to add it, if you already have the LLC, is that what you mean, Karen?
Does she mean if she has the LLC and she wants to elect to become an S Corp, how much would my fee be? Is that what she's asking? There isn't any fee. There isn't any fee if you did it yourself, just to be sure we're clear on that. If you file for the S Corp election, there's a form 2553 and a New Jersey form CBT 2553. There's no fee if you do it yourself. If you ask me to do it, $300 to $400 is what I would charge to do that.
Christina asked, do you need to have an LLC as a real estate agent? Well, Christina, you came a little bit late.
We went over that. We
Yes.
went over that.
And we will share the recording with all of you guys if you wanna go to the, over the call. Jen says,
I have a question. So if your commission checks are being made into your name and you do form an entity, let's say we started with an LLC, do I transfer the amount, the full amount of the commission check, or just what my business expenses would be, and keep the draw that would be my income?
I know it sounds like a lot of work, but you should transfer all of your commission to your LLC. And then when you're ready to take a distribution for yourself, you can take it back out and put it in the original account that it started in, or any other account that you choose. But it should go around the horn that way. I know it sounds ridiculous, but this is how the government works. And the ball game here is not to satisfy me as an accountant or your accountant. The ball game here is to satisfy the government should you be audited. We're trying to bulletproof you from any problems that you would get as being audited. Self-employed people are audited at a much higher rate than people that work for companies and get a W-2 form. Why? Because we have the ability to write off expenses that are not verified yet by the government. So we get audited often. So this whole movement of money thing and making sure that you do things the right way, I'm going to always advise my clients to do things exactly the way I know we would have to defend and prove at an IRS or state of New Jersey audit level. That's the end game for when it comes to accounting and taxes, proving what we're trying to do here. So some of these steps might sound like they're too much and too many steps, but I'm telling you the facts that I think you should do.
Now, if you form an LLC that is not anywhere close to your name, but the check from the market center is in your name, and you try to deposit that in a bank account, do you have to add your name to the part of the business?
No, you just endorse the check. Let's say you get a check for $5,000. It's payable to your name. You can simply deposit that check in your personal account, write out a check from your personal account payable to your LLC's name, whatever that may be, and deposit it. Now, these days, you can do this electronically. Like on my website, I have TD Bank. I have my personal account and I have my company account on the same website. Why? Because I am the only owner of both. I'm on there. So I can then simply move the money from one to the other in a matter of a second without writing checks. And if you want to do that, that's the easiest thing to do in this day and age. I would suggest that. But you definitely want to move all of the money over to your LLC. And then when you're ready to move it back to an investment account or a personal account, move it back.
Patricia, can't you have the deposits go to any account we want, including our LLC?
Not initially. It's the check is being paid to your personal name.
And this is the real estate commission requirement. In the state of New Jersey, we cannot write checks to artificial people, to LLCs, as we say at the very beginning. It has to be on your name, the name that you show as the licensed person.
Right.
So on my LLC bank account, my name is on there and my LLC name. My ACH go to my LLC account.
Okay, if your bank allows that, that's fine. A lot of banks, my bank doesn't allow that.
No, but Patricia, if you don't you do direct deposit? Do you guys still do checks?
I do direct deposit, but in my books and the 1099 that you will receive next year is under your name.
No, I understand that, but I'm just saying for the bank account, if you were doing direct deposits, would we be able to direct deposit into our business account if we had one?
Well, we can, but based on what Dean just said, maybe that's not the proper way to do it. Maybe you should put it first in your checking account. Is that right, Dean?
Yeah, I mean, if Keller Williams, if Patricia is charged with direct depositing a commission check to an agent's bank account, I'm gonna tell her to put it to an account that has your name on it, not your entity, your name. She's supposed to be depositing that check to an account that has your personal name on it. So that's what I'm suggesting to Patricia. Once it's in that account, your personal account, you can move it right over to your business account. It's a matter of one click on your computer.
Okay, so if someone gave me their LLC with their name and it seemed like it was a personal checking account, we need to talk after this phone call. Okay. Jennifer is asking, do you transfer an existing lease into a new LLC?
Yeah, that's a legal matter. So you'd have to have an attorney, I'm assuming, redo the lease, but the answer is yes.
Freddie, should renters make rent payments to the LLC or can it be made to personal name? Should the personal owner name not be listed within the lease agreement? If not, then every time there is a court case, an attorney will need to be hired due to the LLC. So it looks like a couple of questions in there.
If you, let's just take steps here. If you buy a rental property, and you, from the outset, you form an LLC, okay, whatever you call it, you are going to close in the name of that LLC. Now, the bank is going to make sure that they're protected by you guaranteeing personally the mortgage, but the name of the entity that the ownership is in is in the LLC. Now you have tenants. They're going to pay you rent. They're going to pay you rent to the name of that LLC. That's who owns the property. You don't. The LLC does. Okay, the entity does. So your tenants are going to make checks payable to that LLC. You're going to deposit it into your LLC checking account. You're going to pay your bills from that account, and whatever the profits are, you're going to take them out and put it into your personal name.
Freddie, does that answer your question?
And in the lease agreement, just to kind of read about what she's saying here, or Freddie, I'm sorry, Freddie's asking the question. The lease agreement is going to have the LLC name. It's not going to have your personal name. Your personal name should not be shown anywhere.
Right. I mean, the question that pertains to it is that once I've been, when you go to court, usually it states that if you have an LLC under the lease agreement, it automatically states that you have to have an attorney at that court case versus a personal, if you're the personal owner of the property. So I
don't know. Yeah, I don't know that rule, Freddie. I don't know that rule.
Okay.
If that's something that happens often enough, I hope it wouldn't, but if it did in your case, then I can understand you not doing this, because that's be a problem. Maybe if you want that attorney's representation, I could see that being a problem, but I personally have not run into that problem before.
Okay, very well, thank you.
You're welcome.
Hey, Freddie, since you're, because it's an entity, you can't represent yourself in court, regardless of if it's a renter's court or whichever court. So that's why you need a lawyer if you're an LLC.
Okay, guys, do you have any other questions regarding business entities? Okay, let's talk about taxes then.
Great, let's talk about taxes, everybody's favorite subject.
Yes, sir. I was thinking, I have a couple of notes in here. When are the dates for next year? What are the different taxes? One of the things that I noticed when I help agents set up their goals for next year is that they consider the taxes to be like a 30%. But I think from previous conversations with you, you told me that it's actually more than 30%. So maybe something to consider when they are creating their real estate goals. And I also would like to talk about the deductions and the credits and maybe any tricks or tips or something.
Sure. We can talk about deductions and taxes, absolutely.
Yes, sir. So
let me just do this. I'm going to put on my other screen here the tax rates for this year. Okay. So here's the conversation about taxes. We self-employed people, and I'm not a realtor, but I'm self-employed too, so I'm in the same boat as everybody else here. We pay basically four taxes when we file our tax return. Federal income tax is one. Social Security tax is next. Medicare tax is third. And state income tax fourth. Bless you.
Thank you.
So those are four taxes. Now, the Social Security tax is based upon your profits of your business, not your commission gross, but the net profit after deducting all the expenses that you are able to deduct on your tax return. So your net profit. That rate for Social Security tax is 12.4% of whatever that profit is. So to make it simple, if you have a $100,000 profit, you have a little over $12,000 to pay in Social Security tax. And that's going toward your credit of Social Security benefits one day when you retire. So hopefully we get something out of this, right? The other tax is Medicare tax. That's 2.9% of your net profit. It's a lower number, but you're funding your Medicare taxes, which is health insurance for when you retire. The Social Security tax at 12.4% is capped at a net profit of roughly $140,000 for 2020. This number changes every year. It goes up every year. That's why I'm saying roughly. I don't remember the exact wage limit. But if your income from business is over 140, your net profit, I should say, you're capped at the 140. You stop paying that 12.4% at $140,000. But lower than that 140, 100% of your earnings is subject to this. The Medicare tax at 2.9% does not have a cap. You could be making $3 million, you still pay 2.9%. So those two taxes that I bring up first are taxes that are based upon a percentage of your of your profit, okay? That's how they're calculated. It has nothing to do with anything else on your tax return. The other two taxes, federal income tax and state income tax, are going to be dependent on your total income on your tax return. That means if you're married filing jointly, you have wages from a spouse, you have interest and dividends, you have capital gains, maybe you have real estate income, maybe you sold stock, whatever it is, your profits from your business are being added to these other income sources. And when you add them all up, and then you subtract your allowable personal deductions, you end up in a certain tax bracket. And I have it on my screen here. If you're single and you're in the 22% tax bracket, that's between $40,000 and $85,000. If you're married filing jointly, that's between $80,000 and $172,000. The tax brackets go up from there. They go from 22 to 24 to 32 to 35, and the highest bracket right now is 37%. So if you're in a situation where either you, your spouse, or the combination, and you're making over, say, $600,000, congratulations to you, but you're also in the highest tax bracket possible, 37%. Now, 37% plus the 15% Social Security tax, plus the Medicare tax, plus anywhere from 5 to 10% New Jersey tax, depending on your bracket, you're looking at possibly up to 60% in taxes. It's crazy, all right? These tax rates are what we have to live with, but look at it, they're admittedly very high. So this is why the deductions that you are able to come up with to reduce the profits of your business are key. Otherwise, these tax rates are not going to go away. It's just simple math. I made X amount of dollars times the tax rate. I've got to pay this. The only combats that you have are to deduct what you're eligible to deduct, which is a bunch of expenses that we can speak about it in a second regarding what those deductions might be. But we want to capture all the deductions and not lose any. Now, part of the deductions is going to be home office. We're all working from home, especially these days. Your car, even though we're not traveling this year quite as much, typically rental real estate agents have a lot of mileage they put on their car. That's a huge tax deduction, among all the other expenses that you pay out of your checking and debit card and credit cards. And then I also want to say, before I don't let this pass, this is important. One of the biggest problems I see with self-employed people, including real estate agents, is that they don't focus on their retirement benefits and their retirement contribution. Imagine if you worked for a company and they offered a 401k plan. Wouldn't you participate? I'm going to guess yes, because you're getting a tax benefit for being part of that plan. Well, when you're self-employed, you also get a tax benefit for being in a plan. And that tax benefit, the amount of money you contribute, is tax deductible. So you're paying yourself, right? It's going from one account to a retirement account, but it still has your name on it. You're getting a tax deduction for it. And that money is going to earn money, hopefully, in that account. And over the years, that's going to build up. So if you contribute to this every year, it's building up interest and dividends. You're not paying tax on that dividends and interest now. You pay tax on this money one day down the road when you retire. You're deferring today's taxes for later on when you retire, maybe at a lower tax rate. So you're kicking the can down the road, which is the whole idea of 401ks and IRAs and SEP plans, which are simplified employee pension, 401k plans. These are all retirement plans. Too many real estate agents overlook this, or they say to me at the end of the year, Dean, I know you said I should put away some money here. I'm going to save some taxes, but I just don't have the money. I wasn't ready for that this year. Next year, I'll do it. And they don't do it. And the years go by, before you know it, you haven't taken advantage of a great tax deduction that you could have had. And like I said, you're just paying yourself anyway. It's not like you're spending the money and it's down the drain. So I would recommend anybody listening on this call to try to focus on putting money away in their retirement plan of choice, whatever that is, and the options that you have. Very important. No one's going to do it for you guys. You got to do it yourself. So it's a matter of just getting it in your head and putting it as part of your budget and going forward. And you can invest in you can invest this anywhere you want. Fidelity, Merrill Lynch, LPL, wherever, your local bank, many choices.
Dean, that's a great advice. I have a question. If someone have not done this before and they are thinking now, let me make sure that at the end of next year, I do have this money to put away. Is there a minimum or is there a recommended amount that you suggest?
Well, the amount is dictated by the amount of earnings that you have.
Okay.
So there's going to be a maximum, that's for sure. The maximum is going to be based upon how you structured as an S corp or an LLC or a sole proprietorship. But let's say you're an LLC and you want a SEP. A SEP is an acronym for Simplified Employee Pension. Basically, the calculation for that plan is 20% of your profit of your business. So if you made $100,000 profit, you could put away $20,000 as a tax deduction into this SEP plan. So that's what you could do. It's 20%. The maximum SEP is about $56,000 for people that are under 55 years old and $62,000 for people that are over 55 years old. These levels are much higher than a traditional IRA, individual retirement account, which are capped, I believe, at $7,000. So the SEP gives you a much higher contribution level. Now, you don't have to put in the maximum. If you can put in 20, but you only have 15 or 10, great, do it. But this is the maximum. The minimum that you're asking about, Patricia, is depending on where you have the investments held. Some investment firms will have a minimum. They don't want you to contribute less than, $500 or $1,000 or something like that. But I think most of them are pretty flexible when it comes to these retirement plans.
Okay. This is great. Thank you, Dean. Are there any other deductions that we should be thinking about?
Yes. So everything that you spend money on should be looked at as a potential tax deduction for your business. Everything. Because if you're like me, like I say, I'm also self-employed. Everything that I do in my life is somewhat structured to what I do for a living. I'm always talking about exactly what I'm talking about today with you. Friends, family, whatever. I don't charge my family though, maybe I should. But everything that we do has to be looked at as a potential deduction. So whatever you spend money on, if we can tie that to your business activity, even if there's a quasi-personal aspect to it, maybe we can take a portion of it and deduct it against your business. One of the biggest problems that self-employed people have, besides the retirement plan problem that I just went over with you, is that they lose tax deductions because they don't keep track of them properly. And they spend money during the year that never gets onto their tax return because they forgot about it. They focus too much on tax season and they start to think about how much money they spent in certain categories all of a sudden in March, when a year has passed since they started the year. If you can get into the habit of organizing your finances for your business account in some sort of a software, whether it's Quicken, QuickBooks, even using Excel. I mean, I know you have to enter the data in order to get the feedback back, but you're likely to capture all of your costs that way. And costs would be shown on a credit card statement as well as your bank statements, okay? So you don't want to lose deductions, guys, because for every $1,000 that you lose in deduction, if you're in the 30% tax bracket, there's $300 out the door, right? So you want to make sure you have a mechanism for yourself to always keep track of your expenses instead of trying to think in March and April when tax season comes around, how I spent my money and try to gather receipts. It becomes a mess. And invariably, you're going to lose deductions. So that's a key thing, is keeping organization.
Guys, and I just want to remind you, you can use the software that Dean mentioned, but if it's just a spreadsheet, remember that there is a spreadsheet that I have shared with you before, when we were going over the agent's financials that has, I believe, every single category that at the end of the day you need to track in order to have accurate numbers for your real estate business. So if you have not received it, if you don't know where it is, shoot me an email, or actually I'm gonna send it to all of you, when we finish. But it's all the categories that Dean was mentioning. And it's a good way to start just January 1st. When you start spending money, you start tracking it. So you don't have to, look all over the place or as he say, lose any deductions that, you forgot about. Dean, I have a question. What about credits? Are those the same? Are those different? Is this something that applies to real estate agents, or is there anything to say there? Credits.
Did you say credits?
Credits.
Credits are something that are different than deductions. Credits are coming off of your tax. Deductions are coming off of your income to find your tax. There are very few credits that would apply to the average person. Credits such as home energy credits, solar energy credits, maybe buying a electric vehicle, which has become popular. People that are buying a Tesla, for example, can get a $7,500 tax credit. But except for those type of things, Patricia, credits are not part of the average person's tax return.
Okay. I don't have any questions other than anything else that you would like to add, Dean.
Well, I think we didn't discuss how to pay the taxes.
Oh, great.
All right. So the way this works is we self-employed people are supposed to pay our estimated taxes for the year quarterly. Nobody likes to send in payment to the government, I'm included, but this is what the rule is. April 15th is the due date for our tax return normally, okay? And by the way, I'll say if you form an S Corp, that due date is March 15th, not April 15th. So just keep that in mind. But April 15th is our personal tax deadline. We have to pay whatever we owe for the prior year on that date, or maybe we have a credit coming back to us. But also on April 15th, that is the first estimated tax day for the new year. So if we're going to project ourselves a couple months from now into April of 2021, unless they extend the deadline this year for taxes again because of COVID, that's our tax filing deadline. But you also have to make your first payment for the year 2021 on that day. The next payment date is June 15th, then September 15th, and then the following January 15th. So there's 4 estimated tax dates. At the end of the year, if you made a payment on all 4 of those dates, you take credit for those payments on your personal tax return as prepayments toward whatever your tax is that we calculate. Now, some of you may be saying, well, why would I want to do that? I'll just pay at the end of the year. I'll save my money and I'll just pay it at the end of the year come April 15th. Well, there's a penalty for doing that. If you do that and you pay it all by April 15th, there's a penalty for not paying quarterly. It's called an underpayment penalty. And if you're looking to save every tax dollar or not to pay any penalties to the government, you want to pay quarterly. Also, paying quarterly is mandated by law. In a sense, people that don't pay quarterly are actually breaking the law. It's a way that the government will look at your return and say, you know, this person is not doing things the way they should. They're not paying quarterly when they were required to. What else are they doing wrong? Maybe we should look into this person. Okay, it's just another reason that somebody could get looked at by the government. You could eliminate that by just paying quarterly. So I really recommend everybody send in something quarterly. Now, how much depends on what your estimated tax is for that coming year. I know it's hard to think in March how well you're going to do for the rest of that year. We don't know, right? Hopefully you do great. But you start out with an idea of how much you think your profit is going to be, and you can always adjust those payments. So if you come to me as an accountant and you say, I think I'm going to make $100,000 profit, I give you these estimated tax payments based upon that figure. You can call me in June, July, August, September and say, Dean, I know I told you 100,000 was my estimate, but you know what? I'm doing a lot better. I think I should probably pay more. And I would say, of course, I'll recalculate it for you and I'll adjust the last couple payments. Or conversely, if you're not having a good a year as you thought you were going to have, we can bring those payments down. They're just estimated payments. The IRS does not know about them until you file and pay. At the end of the year, when you file your return, that's when the IRS sees whether you are required to make those payments or not. At the end of the year when you file. So hopefully everybody here understands that. If there's any questions, I'll be happy to go over it again.
So the estimated payments you're making, if you're an LLC, would be under your Social Security number. What about the S Corp? Would that be under your SS number or your EIN?
No, your Social Security number, because the profit from your business, whether you're an S Corp, LLC partnership, LLC single member owner, it all falls to your personal tax return. And the reason why is because we want to be taxed one time, not twice. Typical corporations, like big corporations that are on the stock market, they get taxed at an entity level. So their profits are taxed at the entity level. The entity pays the tax, not we self-employed that have these flow-through entities. Flow-through meaning that the profits flow through from the business onto our personal return via this K-1 form that I mentioned to you earlier in our discussion. The only exception to paying taxes personally is if you have an S Corp and you have a salary that you're giving yourself, you would be paying taxes through your entity for your salary. You would get a W-2 form at the end of the year. It would show your wages, you know, the federal tax withheld, state tax withheld. That's all paid through the entity. Except for that, everything falls to your personal return, and these estimated tax payment coupons that I'm mentioning are in your personal name.
Dean, someone was asking, did you cover traditional realtor deductions? I think we talk about car, I think we talk about home office, and how important.
I mean, everything. Your realtor deductions are no different than anybody else's business deductions. I mean, certainly real estate agents have certain deductions that are a little more accentuated than others, like the home office, like the use of the automobile, for example, maybe some travel costs. Entertainment costs are no longer deductible. So buying a client tickets to a show or to a ball game, that's not deductible, but the meals still are. So if you take clients out to lunch or for dinner, I should say when we were allowed to do things like that, hopefully down the road we can again, that's 50% deductible. But everything you spend money on is a potential tax deduction. Realtors have dues, they have desk fees, they have, you know, expenses that are attributable to their particular business. But everything you spend money on is a deduction for your business, or should be looked at as a potential deduction for your business.
Jen, did you have any question in particular in mind? Were you thinking about a category specifically, or can you hear us? Okay, there is a question from Karen. She says, if you pay yourself through your LLC, you pay unemployment tax as well?
No, there's no unemployment tax when you are self-employed. And by the way, you cannot pay yourself through an LLC. If she's referring to payroll, like the S Corp that I was mentioning, that's not allowed for an LLC. Whether you're a single member or a partnership, you're not allowed to be on payroll as the owner. Only employees that you have, if you do have any employees, would be paid through a traditional payroll. But unemployment taxes are only paid by employers and employees that are on a W-2 form, not by self-employed people.
Good, Karen?
Hey, Dean, I just found out that you're my uncle from my mother's father's side. So which means you'll probably do my taxes for free. But for the other people here, what would you charge for income tax?
Wait a minute. I'm related to you. Is that what you said?
Yes.
How?
From my mother's father's side somehow.
Your mother? What? Can you throw a name at me?
No, I'm kidding. You said you don't charge your family for tax returns.
Oh, you're kidding with me. Ah.
So yeah, the question is, what do you charge for to do tax returns?
Okay. So a typical tax return that has a Schedule C in it and other items on it. I don't want to say it depends, but it all depends on the volume of work that we do. Because I'm asked this question almost every single day. I would say our minimum fee for a self-employed person is $500. It can go, the tax return itself can go as high as $1,200, even more if you have all kinds of other activities, rental properties, a lot of capital gains from stocks and bonds. You have various W-2s from a spouse. It all depends on the volume of work that we accountants have to put together. But I can tell you the minimum for a self-employed person that requires a Schedule C is a $500 fee because we have to work to try to get the proper numbers from you and make sure that we gather everything and communicate about the pension deduction if you're going to do that and what your estimated tax payments are going to be. So somewhere in that ballpark.
I just have a question, just going back to the rental property section. If we have a rental property that is under our name to transfer over to an LLC, how hard is that process to do the change?
You have to do it through an attorney typically, but you have to change the deed in the county in which you are where your building is from your personal name to the LLC, and I know they're going to charge a transfer tax of some sort or a transfer fee in order to do that. What that is, how much that is, I'm not sure, but that's a process.
Okay, guys, it's 1 o'clock, 1:01. Do you guys have any more questions? Dean's information is on the beginning of the chat. Again, not because he's here, but Dean has been our accountant for a long time, and all of these suggestions that he, recommended, like the estimated taxes, the payment of the thinking of retirement, all of those things are, we are me and my family, very happy that we are doing it that way. And you know what, guys, if you pay a little bit more than what you should have, next year at the time of actually submitting those taxes or filing those taxes, you will have less to pay. So, talk to him.
Yeah, I'm available. I'm available to speak to anybody in the KW family and to help you as best I can. Of course, tax season becomes crazy for we accountants. It's tough to deal with the volume, but I've been doing it for 35 years. What's one more year? Okay, I'll do it again for sure. This is what I do. But I'm happy to help anybody in the KW family. Some of the conversation and topics that we're bringing up may be very familiar to you, others not so much. But there's something that these topics have to be discussed. You have to understand them. This is your money we're talking about. You have it within your grasp to minimize how much tax you are paying, while also ensuring your retirement future. That's the key. Don't ever discount that. Don't always put it off to next year. That's one of the biggest problems I had. I had just a quick story. I have a real estate agent client, not a KW person, but from where I am. I'm in the Paramus area where I'm located. He's been a real estate agent for 50 years, 50, okay? He never put any money into the retirement plan, and he's kicking himself now because now he's ready to retire. He's almost 70 years old. He's had it, and he has nothing. He didn't put enough money away for himself. He let that money go to other things, buy a car, go on vacation, whatever. I mean, don't be that person. Be somebody that saves money, and that when you decide to retire one day, you can look back and say, hey, I did the right thing for myself. I minimize my taxes and I save for my retirement at the same time. Congratulations if you can do that.
Any questions, guys? Well, Dean, thank you very much. Thank you for being with us today. We are gonna blast this recording to everyone in case they wanna go over the details, and happy holidays and stay safe and warm with this weather, and have a great weekend.
You too, guys. Best of luck. Happy holidays and be safe. And thank you for having me today.
Thank you for being here.